Hi there, and welcome to our finance terminology series. In this video, we're going to look at the balance sheet. What is a balance sheet? How do we analyze a balance sheet from a financial analyst perspective and give you a better understanding of this financial statement? So, a balance sheet can be defined as a summary or representation of a company's assets, liabilities, and owner's equity. From an accounting perspective, a very important formula that we consider is that your assets equals your liabilities and stockholders' equity. Now, let's examine each part of the balance sheet a little bit more closely so that you can have a better understanding of what each segment of the balance sheet represents and how do we interpret it and analyze it from a financial analyst perspective. Let's start with assets. Asset is simply a resource of having economic value that is owned by the company in which they expect to generate a future benefit, that of which being in the form of cash. Within assets, you have current assets, which will be converted into cash or utilized within a year, and you have long-term assets that have a life expectancy of greater than a year. Let's look at each one of these sections. The first being current assets. Within current assets, you have your cash and equivalents. This could be a business cash that is sitting in their business checking account. You also have marketable securities, which could be in the form of stocks, CDs, short-term treasuries, money market, anything that is highly liquid that will be converted into cash within a year. In addition to that, you have accounts receivables. Within accounts receivables, you have the portion of sales that the company hasn't yet collected from customers. Then you have inventory. These are the supplies, so the raw materials that is sitting in the warehouse or finished products that are ready to be sold. In addition, you also have your prepaid assets. This could be any type of insurance that the company has paid in advance. And you have other current assets. Add all this together and you get your total current assets, which again will be utilized or converted into cash within a year. Very liquid. In terms of long-term assets, you have your property, plant, and equipment. This could be machinery, it could be a truck, it could be computer, anything that is tangible that is used to run your operations and of course produce either product or service. Then you have your depreciation, which reduces the value of your property, plant, and equipment. Then you arrive to your net PP&E. In addition to that, you may have long-term investments or marketable securities. You may also have goodwill, intangible assets, and other forms of long-term assets. You add your long-term assets with your current assets and you arrive to your total assets, which is owned by the company in which they expect to generate a benefit, that being in a form of cash flow. Now let's examine the liability part. The liability part simply represents the obligation that the company has to its suppliers, its employees, its lenders, and tax authorities. So let's first look at your current liabilities, starting with accounts payable. This is the amount that the company owes to its suppliers when they get their merchandise or their supplies. Then you have your accrued salaries. This is what they might owe their employees. You also have deferred revenue. This is cash that the company has received, but they haven't rendered the service. Then you have deferred taxes. These are taxes that the company owes to the government or the IRS. You also have current portion of long-term debt. This is capital that the company raised in the form of a loan from either a bank or any other type of lender where they're paying interest on that amount of money. In addition, you have other current liabilities. You add all of these together and you get your total current liabilities, which is expected to be paid within a year. In addition to that, you have longer-term liabilities like your long-term debt or other forms of long-term liabilities. The following section, or the third section, would be your stockholders' equity or owner's equity, which is comprised of common stock, if you're a publicly traded company, shares that you issue. You have paid-in capital, which is the amount of money that has been invested by the owners of the business. You also have your retained earnings, which accumulates your company's net income coming directly from the income statement. And of course, if you are a publicly traded company engaging in share buybacks program, that will be represented or accounted in the treasury stock section. This accounts for any company share buyback if they are a public company. Now, you add your liabilities and your shareholders' equity, it should match or equals what you have on the total asset side. So, simply put, your balance sheet accounts for the assets, liabilities, and stockholders' equity. So now, how do we analyze a balance sheet? We can simply look at working capital or net working capital, which is a measure of liquidity and operating efficiency. If a company working capital is positive, then you know they can meet their current obligations under the liability side. So let's examine a little bit more carefully working capital. Simply, your working capital is your current assets minus your current liabilities, and if the number is positive, like in this example, the company can meet all of their obligations within a year. If that number was negative, then we know that this company might be facing some liquidity challenges in financing their current obligations. Now, we also have a more narrow measure, which is net working capital, where you are removing current cash and your marketable securities, and you're only accounting for receivables, inventory, prepaid assets, minus your total current liability. Another way of measuring a company's liquidity and operating efficiency is by calculating your asset test or a quick ratio. Or you can look at your company's turnover days for working capital purposes. How long does it take a company to convert their current assets into cash inflow, and how long it takes your company to pay its obligations, cash outflow. So let's examine a little bit more carefully the turnover days within a company's working capital. When calculating our turnover ratio days, we need to understand that there is a relationship or a distinct connection between the income statement and your balance sheet. So for example, when we're calculating our turnover days for accounts receivables, the formula is accounts receivable balance divided by your total revenues times 365 days out of the year. For inventory, we're gonna take the inventory balance divided by our company's cost of sales times 365 days out of the year. What these numbers tell us is how long it takes the business to convert their receivables into cash. On the inventory side, how long it takes a company to replenish or to sell the products that they may have in the shelf, or the products and supplies that they may have in their warehouse. On the liability side, if we take accounts payable, the formula for that is taking your accounts payable divided by your cost of sales times 365. This tells you how long it takes a company to pay their suppliers. Also, if we look at accrued salary, we would take the accrued salary balance divided by SG&A times 365 days out of the year. What this number tells you is how often is the company paying their liabilities or the employee's salary. Now, these numbers are very important because it tells us how long it takes a company to bring in cash flow from their current assets, or how long it takes a company to pay out their creditors. When comparing your turnover days with accounts receivables, in this example, it takes a company an average 128 days to convert their receivables into cash. Meanwhile, when looking at the accounts payable side, it takes a company about 219 days to pay their creditors. In other words, cash comes in first and then it leaves the business. So that does create a positive working capital. In the event where the accounts payable turnover days is less than the accounts receivable turnover days, that means that cash leaves the business first and then it comes in, creating a negative working capital. In this case, the company will have to raise money from either lenders or from shareholders. So it's very important from an operating standpoint that you understand your working capital and your turnover days so that you don't fall for any liquidity inefficiencies or challenges. Now that we've given you a summary of what a balance sheet is and how to analyze it, let's look at a real-world example. In this case, we're gonna look at Apple. When reviewing Apple's balance sheet as of June 2020, we can see that on the current asset side, they have 140 billion and their total assets is 317 billion. Now, if we look at the liability side, we can see that their total current liability is 95 billion and their total liabilities or financial obligation is 245 billion. And when you combine the liability and the total stockholders' equity, you get $317 billion. So your balance sheet balances your assets equals your liabilities and your stockholders' equity. Now let's do some quick analysis. Now let's analyze Apple's working capital. If you take the current asset minus current liability, you're gonna arrive to $44.7 billion, which means they can cover their current liability obligations. Now, let's also calculate our working capital turnover days for accounts receivables, inventory, accounts payable, and deferred revenue. For the accounts receivable side, if we calculate our accounts receivable turnover days, taking accounts receivables divided by their revenues on an LTM basis times 365, we will arrive to 24 days. In other words, it takes Apple approximately 24 days to convert their receivables into cash. If we look at inventory and take the inventory balance divided by our cost of sales times 365, we'll arrive to 9, which basically says that it takes Apple approximately 9 days to turn over their inventory, products that might be sitting on the shelf for them to sell, and it's pretty much a really good turnover ratio. Now, if we look at the liability side, accounts payable. If we take our accounts payable balance divided by cost of sale times 365, we arrive to 76 days, which means it takes Apple on average 76 days to pay their third-party business relations that supply them with all of the raw materials and supplies needed to assemble their iPhone and their wearables, the watch, the Mac, any product category that they have that they sell as a product or service. If you look at deferred revenue, you take your deferred revenue balance divided by your revenue times 365 and you arrive to 8. It means that on average it takes Apple 8 days to deliver the service that they've received the cash but they haven't rendered it, which means it takes Apple on average 8 days to fulfill that customer order. Now, let's examine the turnover ratios for accounts receivables and accounts payable a little bit more closely. So it takes Apple roughly 76 days to pay their suppliers. Meanwhile, they're collecting cash from their customers every 24 days. There is a 52-day gap or period in where cash stays within the business, at least 52 days. This allows Apple to reinvest that capital in the form of marketable securities, which allows them to generate interest income. In 2019, Apple generated $4.9 billion in interest income, which is more than enough to cover their interest expense. Ladies and gentlemen, this is a money-making machine. So this is a simple example of how we would read and analyze a company's balance sheet, in this case being Apple. So let's recap what we've done up to this point. We first defined what is a balance sheet. Then we looked at the different components of a balance sheet, the assets, the liability, and the stockholders' equity. We also went through some exercise on how to analyze a balance sheet, working capital, net working capital, and we can even do more analysis like an asset test ratio or a quick ratio. In addition to that, we calculated our working capital turnover days to see how long it takes the company to convert their current assets into cash and how long it takes a company to pay their suppliers, cash coming in, cash going out. So I hope this gives you a simplistic understanding on how to read a balance sheet, but also how to analyze it so that you can further develop your skill set as an analyst. So I hope you find value in this brief introduction to balance sheet and how to analyze it from an analyst perspective, and this helps you with your development and your education. So with that being said, folks, take care, stay safe, and I'll see you in the next one. And if you're a student or an individual looking to further develop your soft and technical skills in stock analysis, then don't forget to check out our financial analyst and investment banking training course, where we design a very structured curriculum with over 90 hours of video lectures, 7 financial modeling assignments, and 4 investment case studies designed to teach you the right process. So what are you waiting for? Enroll today and start analyzing companies like a professional.